Total credit, year-on-year, YoY, refers to the annual growth rate of the total amount of credit extended by financial institutions, such as banks, to households, businesses, and governments. It is a key indicator of credit activity in an economy and reflects the level of borrowing and lending. The December YoY figure specifically compares the total credit in December of the current year to the total credit in December of the previous year. Rising credit growth often signals increased borrowing for consumption, investment, or business expansion, which can drive economic growth. Central banks monitor credit growth to assess the effectiveness of their policies, such as interest rate changes and quantitative easing. Excessive credit growth can lead to asset bubbles or financial instability, while slow growth may indicate tight credit conditions or weak demand. Total credit consists of household credit, which includes loans to individuals for mortgages, personal loans, and credit cards. Business credit, which refers to loans to companies for working capital, expansion, or investment. And government credit, which is borrowing by the public sector, though this is less common in some countries. Several factors influence total credit growth. Lower interest rates make borrowing cheaper, encouraging credit growth. Optimistic households and businesses are more likely to borrow, while tighter lending standards can restrict credit growth. Strong demand for housing or business investment can also drive credit growth. Total credit, YoY data, is typically released monthly or quarterly by central banks or financial regulatory authorities, such as the Federal Reserve, European Central Bank, or People's Bank of China. It is often analyzed alongside other indicators like money supply, inflation, and GDP growth. During economic recoveries, credit growth often accelerates as businesses and households borrow to invest and spend. Conversely, during recessions, credit growth may slow or decline as demand for loans weakens. Credit growth is closely linked to consumption and investment, which are key drivers of GDP. Rapid credit growth can lead to inflationary pressures if it outpaces economic output. Investors monitor credit growth to assess the health of the banking sector and overall economy. Central banks use credit data to guide monetary policy and ensure financial stability. Lower interest rates typically boost credit growth, while higher rates may slow it. Excessive credit growth can fuel inflation if demand outstrips supply. High credit growth can lead to rising debt levels, which may pose risks to financial stability.